This video will walk you through some typical calculation questions that you will see when doing business decisions from Chapter 12. The company has two divisions, North and South. The divisions have the following revenues and expenses. So you can see they outline the sales and the variable expenses, and because we have fixed costs, we want to know how much of the fixed cost is traceable to each of the products and how much is common. The common fixed costs are things that are not directly traceable to the product, and if you eliminate the product, those costs are normally going to stay with the company and then have to be redistributed to any remaining products still being built. So if we look here, we can see currently our total net income is $50,000 with these two products. And North, which is losing money right now, has total fixed costs of $260,000 and $240,000 or $500,000, but it has a whopping $240,000 of allocated common expenses. And those common fixed costs, if we eliminate North, will stay with the company, and South is going to have to absorb it. So it says management is pondering the elimination of North Division. If North Division were eliminated, its traceable fixed costs would be avoided. So avoided means it's going to be gone. The total common corporate expenses would be unaffected. Given these data, the elimination of North Division would result in an overall company net operating income of. So it's asking us what would be our new income. Well, South currently has $100,000. If we eliminated North, it would have to absorb $240,000 of expenses, which would give us a new net loss of $140,000. So we went from $50,000 profit, even though North was losing money. It was helping us because it had, when you look at $900,000 sales, $450,000 variable expenses, it had a contribution margin of $450,000. That $450,000 was absorbing not only its traceable costs, but a good portion of the common costs as well. If we eliminate it, we lose the $450,000 of contribution margin we get from North, and we also lose the $260,000, but we still kept the $240,000, which then goes against South and leaves it with $140,000 net loss. So the answer is C. Next question, number 20. The company makes 4,000 units of part U13 each year. This part is used in one of the company's products. The company's accounting department reports the following costs of producing this part at the level of activity. It shows our direct materials, our direct labor, variable manufacturing overhead, supervisor salaries, depreciation of special equipment, and allocated general overhead. An outside supplier has offered to make and sell the part to the company for $21.60 each. If this offer is accepted, the supervisor's salary and all of the variable costs, including direct labor, can be avoided. The special equipment used to make the part was purchased many years ago and has no salvage value or other use. The allocated general overhead represents fixed costs of the entire company. If the outside supplier's offer was accepted, only $3,000 of those allocated general overhead costs would be avoided. So you could only lose $3,000 of that cost. In addition, the space used to produce the part U13 would be used to make more of the company's other products, generating an additional segment margin of $13,000 per year. What would be the impact on the company's overall net operating income of buying part U13 from the outside supplier? So now what we're going to do is figure out what does it cost to make and what does it cost to purchase. So if we make the product, we incur direct materials, 4,000 units per the information, it's $6.20. So that's going to be $24,800. Direct labor for the 4,000 units at a cost of $4.40 would be $17,600. Our variable overhead for the 4,000 units is $6.80, or $27,200. The supervisor salaries is $10,000. We got that by taking 4,000 units times $250 a unit. Then we've got depreciation of the equipment. This is a sunk cost. Therefore, it's zero. What we mean by sunk cost is, if we make, we incur this cost. If we buy, this cost is zero for direct materials. It's zero for direct labor, zero for variable overhead, zero for the supervised salaries. They differ. Depreciation equipment would be the same whether we use it or not, and therefore it's going to be zero for both. Or if what the cost was, which is $860, you can also put $860 times 4,000 under both of these, but it would be under both of them, so it's a wash. So this is a wash, and you ignore it then. Then we have the general overhead, and all we want is the avoidable, and we can avoid 3,000. And that would be zero there. The remaining 25,000, and I get the 25,000 because we look at what they tell us. 7 times 4,000 units is 28,000. 28 minus 3, 25,000. So 25,000 is the unavoidable cost, and therefore that's what, if you did both sides here, you would say 3 and 0, and you can do 25 and 25, similar to what we did up here with depreciation. There's no difference here. So if there's no difference, you ignore it then, because all we care about is noticing and noting the differences, which is that we'd only incur 3,000, of which we're not incurring under the buy decision. Then we have the opportunity cost. And this can be treated two ways. You can treat it as a cost, namely, under the make decision, if we decide to continue making, we lose the future benefit of getting that 13,000 revenue. And therefore, under the buy column, it's actual cost, increase our cost. So doing it this way, we get a cost of $95,600. And I'm actually going to move this down a little bit because we're going to put one more line in here. Now the last thing to think about is the purchase price. If we purchase, and that's $21.60 per unit times the 4,000 units, and that would be a cost of $86,400. So $86,400 gives us a difference of $9,200. Now I'm going to show you how we can treat that opportunity cost a different way. Instead of saying it's a cost here, I could treat it as a revenue. But if it's a revenue, it's going to reduce my cost. And what I'm doing is saying, if I purchase for $86,400 these products, my units, I'm going to be able to produce some more of another product, and that's going to earn me $13,000. So in my decision to purchase or to buy, I'm going to be able to earn $13,000 in revenue, which is a reduction of my cost. And if it's a reduction of my cost of purchasing the units, so $86,400 400 minus the 13,000 of revenue gives me total cost of 73,400. And therefore, if I take and adjust the cost here by removing the 13,000, if I'm going to treat it as revenue, I can only use it on one side. So if I treat it as revenue, therefore it reduces my cost here, then I'm only going to add the cost. Whoops. Then I'm only going to add the cost here. And when I do that, I get 82,600. And if you notice, the difference still, if I can get my tablet to cooperate, is still 9,200. So you can treat the opportunity cost as a cost under the make column, as I did here, and that's going to increase the cost of making, or you can take it and instead of treating it as a cost under the make column, treat it as revenue, a reduction of my decision to purchase the product, and therefore it's going to reduce my purchase price, and then all I have is the cost that I avoided for when I don't make my product, which is just taking the total cost here less the 13,000. Either which way, you'll still have a difference of only 9,200. Next question, number 21. Company has received a request for a special order of 8,000 units of product W68 for 2720. Product W68's unit product cost is $18.50, determined as follows. So you can see we've got direct materials, direct labor, and both variable and fixed overhead for a total of $18.50. Direct labor is variable costs. The special order would have no effect on the company's total fixed manufacturing overhead costs, meaning we would not be able to avoid any fixed cost. The customer would like modifications made to W68 that would increase the variable cost by $790. So we'd have an additional $790 of costs. And that would require an investment of $31,000 in a special molds that would have no salvage value. This special order would have no effect on the company's other sales. The company has ample spare capacity for producing the special order. If the special is accepted, the company's overall net operating income would increase by what? So, what we want to know is what's going to be our incremental or new revenue, and that's going to be the 8,000 units times the 2720. So that's going to be 217,600. Then I'm going to reduce it by the differences in my expenses. My direct material is going to be a cost of 8,000 units times its cost per unit of 220. So that's 17,600. My direct labor for the 8,000 units is at a cost of $7.90 for a total of 63,200. My variable overhead, remember, it's going to be the 8,000 times $1.50 plus the $790 for a total of 75,200. The fixed overhead, there is no difference. It's zero. None of it could be avoided. And we have to also have a special molding at a cost of $31,000. So we get total cost of $187,000. Therefore, my incremental or change in net operating income would be the difference of $217,600 less the $187 cost, or $30,600. Answer C. Next one we're going to use to answer questions 23 and 24. We have a company that makes 4 products in a single facility, A, B, C, and D. And we're given all the costs, materials, labor, and variable and fixed overheads, and therefore we have our total product cost. Then we have additional information for each of these products: grinding minutes per unit, selling price per unit, variable selling cost per unit, and monthly demand in units. Grinding machines are potentially the constraint in the production facility. A total of 53,600 minutes are available per month on these machines. Direct labor is a variable cost for the company. How many minutes of grinding machine time would be required to satisfy demand for all 4 products, and how many units should be produced of each product? Okay, so to do 23, which is what's the total minutes, we're going to show A, B, C, and D. And then what's the minutes per units per the information. Just copying what they gave us: 380, 5.3, 4.3, and 3.4. Then what's our demand? 4,000 for A, 4,000 for B, 3,000 for C, 2,000 for D. Then we just multiply them, and that's going to be the total minutes. So for A, we need 15,200. For B, 21,200. For C, 12,900. And for D, 6,800. Therefore, if you add them all up, total minutes equals 56,100. Now remember, that's a problem because our total minutes available, if we go back up here, is 53,600. So here's our total minutes that we need. We only have available 53,600, which is why we're given the question number 24. How many units should be produced? Because now we've got a limit of 53,600. We can't produce all of the demand. So what we're going to do in order to determine what to produce is we're going to calculate the contribution margin per grinding minute again. Whichever products give us the highest, we'll rank them 1 through 4. And we will produce total demand for each of the products until we run out of minutes. And then whichever ones we run out of, we will produce what we can. So do the same thing again. Have A, B, C, D. So the first thing we want is we've got our selling price per unit. We were told it's 76.10, 93.50, 87.40, and 104.20. Then we want our variable cost per unit. Now be careful here. They give you direct materials, labor, variable overhead, and manufacturing overhead. You only want the first 3 here, and you need to make sure you add the variable selling cost per unit. So for A here, if we add the 1430, the 1940, the 430, and the 220, we get a total variable cost of 4020. Do the same thing for B, C, and D. You get total variable costs for B of 4150, 5050, and 5580. So therefore we get contribution margin per unit, taking the differences. 3590 for A, 52 for B, 3690 for C, 4840 for D. Now, if we were not limited by constraint, we could produce B first, then D, then C, then A. Next, we want the number of minutes it takes per unit. That's 3.8 minutes for A, 5.3 minutes for B, 4.30 for C, and 3.40 for D. And therefore we get a contribution margin per minute, 9.45 for A, 9.81 for B, 8.58 for C, and 14.24. So now, looking at these, number 1 would actually be D now. Number 2 would be B. Number 3 would be A. And C is number 4. So with that, that says that, now, and remember, we're going to put the demands down here, so remember what the demands are. It's 4,000, 4,000, 3,000, and 2,000. And we know the number of minutes was from the first question, 15,200, 21,200, 12,900, 6,800. So we're limited to a total of the maximum minutes equals 53,600. So we know we can produce all of number D, or D, which is our number 1, because it takes a total of 6,800 minutes. We can produce all of B, or our second priority, because it takes 21,200. We can produce number 3, because so far we're at 28,000. And then 53,600 minus 28,000. We still have 25,600. That's more than enough for A, which is our third priority. So we can minus the 15,200. When we do that, we're left with 10,400 minutes. And our last product needs a total of 12,900 minutes. So, how much of C equals 10,400 minutes? We're going to divide it by minutes per unit. And it tells us that we can then produce 24,1800 and it's like 0.60, but you can't make part of a part, so 2418 is the total number of units of C, which is our fourth priority. So you would build all of demand for number 1 or D, all demand for number 2 priority or B, all the demand for number 3 or A, and then 2418 units, and which would come to a total of 53,600 minutes, which is our maximum number of minutes available.